Everyone knows General Motors as a car company, but I think Wall Street is valuing it completely differently. While investors are chasing Nvidia, Tesla, and AI software companies, GM is quietly becoming something much bigger. AI-powered manufacturing, software, autonomous driving, defense, insurance, and one of the largest shareholder return programs in America. Then today, GM reported its 2026 quarter 2 earnings, and the results may have strengthened that investment thesis even further. So let's dive into the numbers. Section 1. The market is looking at the wrong business. Most investors still classify GM as a cyclical automaker. That mindset may be outdated. Today's GM is building multiple profit engines beyond selling vehicles. Management is investing across AI-enabled manufacturing, connected software, Super Cruise, EVs, GM Defense, GM Insurance. Mary Barra has repeatedly emphasized that future growth will come from margin expansion and operating efficiency, not simply selling more vehicles. Section 2. Q2 2026 earnings. Today's results. Today's earnings tell an important story. GM reported revenue $48.03 billion, up about 1.9% year-over-year, beating analyst expectations. Adjusted EPS, $3.57, comfortably above consensus estimates. The company raised its full-year 2026 adjusted EPS guidance to 12 to 14, marking the second guidance increase this year. Management also highlighted 8.6% North American adjusted EBIT margin, up 2.5 percentage points year-over-year. Lower warranty costs, reduced EV losses, improving manufacturing efficiency, a profitable international business, including China joint ventures. Those are signs of improving execution, not just improving demand. Section 3, the story nobody is talking about. Everyone focuses on EV deliveries. Wall Street appears focused on profitability. GM isn't trying to win every EV sales headline. Instead, management is concentrating on improving margins, reducing EV losses, lowering tariff exposure by reshoring production, expanding software and services, and growing businesses such as GM Defense and GM Insurance. Those businesses can diversify earnings beyond traditional vehicle sales. Section 4. Why institutions still own GM. This surprised me. Despite concerns about tariffs, EV competition, and slowing deliveries, GM raised guidance. That's usually not something management does, unless they have confidence in the business outlook. They also continue returning capital through dividends, significant share repurchases, and disciplined capital allocation. Institutional investors often value companies that combine strong cash generation, improving margins, and shareholder returns. GM continues to emphasize those strengths. Section 5. Risks. Every investment has risks. GM still faces slower global vehicle deliveries, intense EV competition, tariff and supply chain pressures, execution risk in software and autonomous driving. Those challenges help explain why the market doesn't assign GM the same valuation multiples as many technology companies. Section 6. My investment thesis. Here's why I think GM deserves a closer look. The market is still pricing it primarily as an automaker. Management is trying to build a company with multiple earnings engines: manufacturing, software, AI-assisted driving, defense, financial services, insurance. If those initiatives continue improving margins and generating recurring revenue, today's valuation could look different several years from now. That doesn't guarantee outperformance, but it does create an interesting setup for long-term investors willing to follow the execution rather than the headlines. So here's my question. Is General Motors still just a car company, or is Wall Street quietly buying an industrial technology company before everyone else notices? Thanks for watching Stock Market Analyst. Stay informed, invest wisely, keep growing.